Hello everyone, I'm Sebastian Y and this is Foundations of Economics. In this video, we're going to start our study of macroeconomics by introducing the concept of the GDP and doing some GDP accounting. The gross domestic product, or GDP, measures the total income of a nation defined as the market value of all final goods and services produced within a country in a given period of time. What we mean by final good is a good at the end of a chain of production processes. By only including the final goods, GDP accounting avoids double counting. For example, a car consists of many parts, such as the body, windshield, engine, and wheels. The GDP counts only the price of the final car. It does not include those individual parts by themselves. If the firm that assembles and sells the car buys an engine from another firm, that purchase is not counted in the GDP, since that engine eventually becomes part of the final car itself. We should also note that GDP only includes economic activity that can be measured. This means production that stays inside the home is not counted, even if it adds value. For example, a meal made and consumed in your home does not add to the GDP, beyond the value of the ingredients that were used to make it. A meal served in a restaurant would count as part of the GDP, but in that case the ingredients wouldn't because they were not part of the final good. Underground markets such as illegal drugs are also not counted as part of the GDP. Note as well that the GDP is a measure of economic activity within a country's borders. You might have heard of another related concept called the gross national product, or GNP. The GNP is the market value of all final goods and services produced by citizens of a country in a given period of time. This distinguishes it from the GDP, which is within a country. For example, if a Canadian citizen works in the United States, their income is part of the United States GDP, but it's part of Canada's GNP. We will mostly focus on GDP in this course. We will use the variable y to denote the GDP of a country. GDP is split up into 4 components. We will write y equals c plus I plus g plus nx. C stands for consumption. Consumption is spending by households on goods and services. Consumption does not include spending on new housing. We'll get to that in a minute. Goods can be classified as either durable or non-durable. A durable good is a long-lasting good that's used over and over, like a refrigerator or a car, while a non-durable good is something that does not last a long time, like a sandwich. Consumption also includes services, which are purchases of intangible things that you don't take home as a physical good, such as education. I stands for investment. Investment is spending on capital goods, housing, and inventories. In economics, capital refers to physical equipment, including buildings that are used in the production of other goods and services. The economic definition of capital does differ from the finance one, so keep that in mind. Capital depreciates over time, meaning it becomes less effective as it ages. As a result, firms need to constantly invest in their capital to maintain their level of capital or to increase it. Households also contribute to investment by buying housing. The last part of investment is inventories. If a good is produced but not sold in a given time period, it goes into a firm's inventory. It's not purchased by a consumer, so it does not count as consumption, but it was still produced within that time period and we need to count it. Additions to inventories count as investment. However, if in a future time period a household buys the good, then that purchase counts as consumption, but we don't want to double count that production because we already counted it in a previous period's investment. So to compensate for that, we need to subtract the purchase from investment once it moves out of an inventory and is consumed by a household. That means when a good is consumed out of an inventory, there's a net zero change to GDP the year it's consumed, because consumption goes up, but investment goes down. The third component of GDP is government spending. Government expenditure includes spending by governments at all levels, so local, state, and national, on goods and services. This includes paying the salaries of government employees and public works such as road construction. It's important to remember that government spending does not include transfer payments. Transfer payments are things like Social Security and unemployment benefits that are payments to households, but not in exchange for any good or service. This is because nothing was actually produced there, so we don't want to count that as part of our gross domestic product. More recently, if you got a stimulus check during the COVID-19 pandemic, that would be an example of a transfer payment. The final part of our equation is net exports. We define net exports as the spending on domestically produced goods by foreigners, that's exports, minus domestic spending on foreign produced goods, which are imports. We're going to use an M for import since we already used I for investment. Substituting this into our GDP equation, we can rewrite that as Y equals C plus I plus G plus E minus M. It's important to note here that even though imports enter into this equation as a negative, importing goods does not actually reduce GDP. The reason we have to subtract imports here is that any good that's imported is counted as part of either C, I, or G. For example, if I were to buy a good that was produced in China, that would count as consumption. But that good was not actually produced within the United States, so it really shouldn't be part of the GDP. This is why we would also subtract the value of that good in imports, which is our M variable. This means that that good purchased from China has a net zero effect on the US GDP. That makes sense because it was not produced here. Thinking about exports, we need to include those as a positive in the GDP equation because they are still produced within the country but do not count in either C, I, or G. So we need to account for them here. In the US, the Bureau of Economic Analysis, or BEA, measures GDP quarterly. That's periods of 3 months, and have done so since 1947. Since the GDP fluctuates seasonally, the BEA makes some seasonal adjustments to smooth this out. Keep in mind that the GDP figures are usually presented at an annual rate. So even though the GDP is measured every 3 months, once they've made those seasonal adjustments, they multiply everything by 4 to keep everything at that consistent annual rate. This has been the basics of GDP accounting. In the next video, we'll go a step further and look at the concepts of nominal and real GDP.